Michael Burry is the king of short selling. He foresaw the dot-com bubble, the 2008 recession, and is now predicting the biggest market crash in US history. Burry recently warned about a vast array of indicators that may be pointing towards a massive crash ahead. But this video is not a typical market crash video. I'm simply going to objectively present and analyze the implications of China's situation and several indicators. The purpose of this video is not to spread fear, but to inform you about the serious risks ahead. Michael Burry always puts his money where his mouth is, and usually makes large sums of money doing so. From the years 2000 to 2008, Burry averaged a return of 28.6% per year, and from 2016 to the present day, Burry averaged a return of 22.8% per year. These kinds of returns are on par with the greatest investors in the world. But this isn't to say that Burry knows exactly when the market is going to crash. Timing market crashes is extremely difficult, and Burry is not immune to that difficulty. One of Burry's investors once said that a classic Burry trade goes up by 10 times in value, but first goes down by half. This type of pattern may be occurring again. Michael Burry was early to the 2008 recession and could be early again. Burry first warned of a market crash in December 2020, so he is likely down on his positions at the moment. Nevertheless, Michael Burry has always been right in the end, and may be right again in this situation. Burry recently shared a 53-page article talking about the micro and macro elasticity of markets and the intuition behind the GIV estimator. Unless if you're a market expert, you're probably confused as to what I just said. Although the research report sounds complicated, the concept is actually quite simple. Let's say an investor sells $1 of bonds and purchases $1 of stocks. The question is, what will happen to the overall valuation of the bond and stock market? A simple model would tell you that the bond market would go down by $1 and the stock market would go up by $1. That is not the case in reality. Using a variety of calculations, researchers found out that $1 invested in the stock market would actually result in the market going up by $5. This is because when people purchase stocks, it incentivizes mutual funds to purchase stocks as well. For example, let's say someone invested $10 in the stock market, which leads stock prices to increase by $10. This causes a mutual fund to invest $10 in stocks as well, because they want to get in on future returns. Because that mutual fund invested $10, stock prices would increase by $10 again, bringing the total increase to $20. That $20 increase would then lead another mutual fund to invest $10, bringing the total market increase to $30. According to the mathematical models in this research report, every $10 invested in the stock market right now would cause the overall market to go up by $50. The problem with this ratio is that it won't always stay the same. Burry tweeted that if $5 of incremental market share results from $1 added to stocks, and 90% of millennials aka future wealth owners are in passive market vehicles, that 5-to-1 ratio will get much sillier in time. COVID didn't stop it. Inflation might not. #epiphany. Burry then elaborated by saying that the first step is to recognize that 5-to-1 is not a natural ratio. It is a product of a paradigm. So what will continue this paradigm? What may reverse it? This is the knife's edge, because we are at 5-to-1. It may go to 100-to-1, or become -5 to -1, but parabolas don't resolve sideways. Because market valuations are extremely high, a small negative event could trigger a massive crash ahead. Nobody knows when a market crash is coming, but almost any bearish event can trigger a crash. As I've covered in previous videos, Michael Burry believes that we are in a situation similar to the dot-com bubble. Burry found out that the price movement 15 years before the year 2000 was heavily correlated to the most recent 15 years. He tweeted that there is a 94% correlation between the Nasdaq 100 in the 15 years today and the 15 years to 2000. The S&P 500 shows 95%. This correlation implies that we are at valuations similar to the dot-com bubble. Many of us know that valuations are extremely elevated right now. The P to E of the S&P 500 is reaching all-time highs. The Buffett indicator is the highest it's ever been. Margin debt, which are loans that purchase stocks, has also reached record highs as well. All of these indicators are showing that the market is on a knife's edge. One negative event could lead to the biggest crash of all time, and that event could just be the collapse of Evergrande. So what is Evergrande? Evergrande is a real estate company that owns over 1,300 real estate projects in roughly 280 cities in China. That sounds impressive on the surface, but Evergrande is also the most indebted real estate developer in the world. The company has borrowed over $300 billion worth of loans and is now failing to pay the interest on its debt. Evergrande recently struck a deal for a $35.9 million interest payment, but it still has one more payment of $83.5 million coming soon. Evergrande's management team is backed into a corner and has already started to repay investors with actual real estate property. So why does this all matter? First of all, Evergrande isn't just a developer in China. It's a company that has loaned out billions of dollars worldwide, which includes Citibank, JPMorgan Chase, UBS, HSBC, and Bank of America. If all of these banks suddenly lose billions of dollars, then they may stop lending money and therefore freeze the financial system. There may also be another segment impacted, which is crypto. One cryptocurrency named Tether is a very popular stablecoin, which means that it's a coin that's supposed to be worth $1 for every coin. The problem with this is that Tether doesn't actually have $1 for every Tether coin. Tether claims to have a reserve of holdings to ensure that each Tether is worth $1. As you can see in this pie chart, over 65% of Tether's reserve is in commercial paper. Commercial papers are short-term debt notes issued by companies to investors. For example, if Apple wanted to issue $100 worth of commercial paper, or CP in short form, then Apple would sell $100 of CP to a lender. That lender would then receive interest for a certain period of time, which is usually up to 1 year. The ultimate question in our current situation is, what kind of commercial paper does Tether have? And by the way, this is not a small amount of money. Tether reportedly has $42 billion worth of crypto reserves, and these reserves are very questionable. Michael Burry recently retweeted a Twitter thread that hypothesized that Tether was financing China property developers via CP. That might sound crazy, but if it is true, then Evergrande's collapse could create a crash in the entire crypto market. The Twitter thread stated that, by now, everyone knows about the Tether reserves. Notably, they claim 50% of their reserves are commercial paper. Many, including myself, assumed the CP was just some sort of loan between Tether and the exchanges, but it's notable that Tether has empathetically denied this. Tether's legal game is to say positive true things, while not revealing the bad true things. So the D Bosa CNBC interview yesterday was incredible, categorically affirming that the CP is real, AA rated international CP, but refusing several direct questions on whether it's Chinese. Every commercial paper has a letter rating that goes from A to C, with AAA being the lowest risk and C being the highest risk. Tether claims to have AA rated CP, which is usually deemed as not risky, but Tether may be talking about the borrower's banking affiliates, not the actual borrower itself. One Reuters article described how CP has been used as a legal loophole for Chinese companies to obtain funding, because CP usually does not have to be reported in financial statements. This is not the case anymore. Chinese regulators are now demanding that developers have to report their monthly CP. The Reuters article also explained how one Evergrande affiliated bank is under investigation for illegally loaning up to $20 billion. The question is, who is the loaner of this $20 billion, and who is the borrower? Several clues are indicating that Tether is the lender of the $20 billion. First of all, no reputable borrower would ever do business with Tether, because Tether is very shady. And even if reputable borrowers did do business with Tether, they wouldn't borrow tens of billions of dollars unless they really needed it. Further clues also point towards Tether as a lender. On July 1st, after the Chinese bank was investigated, Fitch Rating, a noteworthy credit analyzer, explained how stablecoins could be posing credit market risks. Fitch directly mentioned Tether as a potential candidate for a credit collapse. This happened around the same time that the Boston Fed president stated that stablecoins are posing a major risk. Janet Yellen, the US Secretary of Treasury, and Jerome Powell, the Fed chairman, have recently also been attempting to act quickly on stablecoins. As if it couldn't get any worse, Jim Cramer has been calling Tether a ticking time bomb and has said that he has quote-unquote Chinese sources, suggesting that Tether's commercial paper is Chinese. That's right, Cramer has sources saying that Tether is a ticking time bomb.
Instead, in the last months, lots of important institutions and politicians have started looking into the risk from stablecoins, especially Tether, perhaps at our incessant prompting. I think that's fine, but it's also a step in the right direction. But not enough is being done to fix what many, including some of my Chinese sources, say is a ticking time bomb.
So we know that Tether may be lending large sums of money to Chinese real estate developers, more specifically Evergrande. But why does this all matter? First of all, this is not a small-scale event. Tens of billions of dollars are invested in Tether right now, and if Tether collapsed, it may just destroy the entire financial system. Michael Burry retweeted a tweet that said, "Again, it's certainly possible Tether is buying other Chinese bank or developer CP, or making up the CP concept entirely, but consider the implications if true. The crypto universe may be riding on the back of China's collapsing property developers. The collapse of Evergrande may not just mark the crash of one real estate developer, but the entire financial system. Burry added his own comment by saying, "When Chinese CP is not the Communist Party and is maybe a bigger deal." To sum it all up, the market is on a knife's edge right now, and the collapse of Evergrande could become the trigger for a massive crash. So there you have it, Michael Burry's prediction of how the biggest crash in US history may occur soon. I personally think that Tether and Evergrande are both very shady. However, when it comes to the market crashing, I actually agree more with Ray Dalio, who thinks that Evergrande will be a manageable situation. Given everything the market has gone through, I can't see Evergrande crashing the entire stock market, but that's just my personal opinion. Let me know what you think about Evergrande down below. Will this be the trigger of a humongous crash? Thank you for watching as always. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.